Hi, everyone. This is Lelaine. We will get started in just a few minutes. We'll give everyone a few minutes to hop on. Thanks. Thanks, everyone, for joining. We'll get started in a couple of minutes, just allowing a couple extra minutes for people to join. Hello, everyone. Thank you for joining us. My name is Lelaine Bigelow, and I'm the Executive Director of the Georgetown Center on Poverty and Inequality. At GCPI, we believe progress happens when policy is grounded in people's lived experiences. People-centered policy means listening closely to families themselves, understanding how systems show up in their daily lives, and designing solutions that reflect reality. When we center people in how we analyze data and evaluate policy, it helps us better understand what's working, where the research gaps are, and what needs to change. And today we're going to explore the nexus between the research and the possibilities. I'm excited to welcome you to the second of our new four-part series, The Future of Economic Support, Cash Credits, and Family Prosperity. For years, we're stuck debating whether cash works, but the evidence is clear. It works. Now I believe the question is different. How do we build on a policy that we know works and design policies that take us further? That's why I'm so honored to have someone who has helped shape the national conversation around equity when it comes to the child tax credit and earned income tax credit, Margot Crandall-Hollick, Principal Research Associate for the Tax and Income Supports Division at the Urban-Brookings Tax Policy Center. Through her research, Margot has helped us understand how tax credits like the child tax credit and earned income tax credit function as some of the largest cash support systems in the United States. Her work shows how policy designs shape whether families, especially those with the lowest incomes, are actually able to access cash supports. Today, we're excited to explore what those lessons mean for how we think about cash policies more broadly, including guaranteed income. Margot, we're grateful you're here and excited to learn from you.
Thank you so much for having me. I'm very excited to be here.
For our audience, feel free to start thinking about any questions you might want to ask Margot, and please drop them in the Q&A box at any time. So before we dig in, Margot, I think it's important that we clarify the jargon. For those that might have heard the terms child tax credit or EITC, they may not be exactly sure what they are. Can you give us a little bit of an explanation, please?
Yes, I love kind of starting with the jargon, and I'm going to also go through a few slides showing how these credit amounts are calculated with income in just a little bit. It'll be the shortest PowerPoint I have ever done, 3 slides, and then we'll get back to the conversation. But I want to take a step back. We don't often think about the income tax system as one of the largest supports for families with children in this country, but it really is the main way that kids in families with workers get cash support. They do it through those 2 tax credits you talked about, and those 2 tax credits are refundable tax credits, which is just a fancy way of saying they're not limited by what a family owes in income taxes. And that's important because the income tax system is designed so that low-income families pay little to nothing in income taxes. They pay a lot of other taxes. I want to be clear. Many families pay a lot more in the taxes for Social Security and Medicare than they do in income taxes. But because of our income tax is designed, any tax benefit or provision that lowers what you owe in taxes isn't going to help people who don't owe taxes to begin with. So they're refundable, and that's really important. And I kind of wanted to just go through just the basics of how they're calculated. This is the famous trapezoid that if you work on Capitol Hill, you probably see in lots of leaflets. And I want to start with the EITC because this is, for a long time, this was the major player in town, believe it or not. I know the CTC has gotten a lot of attention, but the EITC for a long time was the biggest source of essentially cash assistance for working families with kids. And this is what sometimes is called a benefit schedule. They all kind of are oriented the same way. The horizontal axis is a family's income. The vertical axis, which I've cut off to make this look prettier, but is the amount of the credit. And the lines trace out the relationship between income and the amount of the credit a family can receive. So there are 3 key takeaways for the EITC that I hope you get from this chart. The first is if you don't have any kids that you can claim for the credit, we often just simply refer to those people as childless for ease of exposition. You get a really, really small credit. It's right at the bottom. It's so pale, you can barely see it. The other thing you can see is that the credit has this, again, trapezoid shape where it phases in with earnings, it reaches its maximum, and it's kind of flat over another range where it's at its maximum, and then it declines in earnings. And that's the means testing, targeting this benefit to lower and moderate income working families. In this case, it's all about earnings. And then the final thing you can see is that when you have more children with the EITC, up to 3 or more, you get a bigger credit. So it varies currently by family size up to a point. Now I want to contrast it with the child tax credit, which gets a lot of attention because it was so important during the COVID-19 pandemic. So next slide, please. So it kind of looks the same. I've put 2 credits here. There is another credit if you have a dependent that's not eligible for the child tax credit, you can get this other credit in the orange. I'd ignore that for now. This is what the child tax credit looks like, that benefit schedule, again, varying by income. And I want to focus, because of what we're talking about today, really on the left-hand side of that chart, the low-income families. So I want to just this is the last slide, I promise, kind of dig deep into how the credit phases in for low-income families. So next slide, please. And so, yeah, if we go back one, so I kind of am breaking apart the phase in here and like showing you how, you draw it. I used to draw this on whiteboards for people, and it was helpful. And so if you look in the lower left-hand corner, you see this little gray line at 0, and that's because unlike the EITC, which phases in with the first dollar of earnings, you have to have more than $2,500 of earnings if you're low income to get the credit. And so in this case, it's 0 for people with less $2,500 or less. Next arrow. So then the credit phases in with earnings at a rate of 15%. That's the steepness of the line. The faster it phases in, the steeper the line, and the more credit you're getting at any given income level. Next arrow. And then you can see it kind of gets stuck. It's like there's this little plateau that you don't see with the EITC, and that's because the maximum amount that you can receive as a refundable credit is capped. It's currently capped at $1,700. That is $500 less than the $2,200 child tax credit we often hear about. And so these three parts, when the credit starts phasing in, how fast it phases in and what it phases into are the most important parts of the phase in of the credit, and changing those can really change the benefits that low income families receive. I will say, if we're going to talk about ARPA and we're not going to have this probably slide in front of us, what full refundability is that it's flat at whatever maximum amount you want it to be. So there's no phase in at all, and we can kind of talk about that when we chat more about what happened in 2021. But just to finish out the phase in, if you do the next arrow, you'll see it phases in again, and people often are like, what is this? At this point, a family starts owing income taxes, and so they're receiving the credit as a mixture of both this refundable portion and as a reduction in their income tax liability. Next arrow. And this is also kind of a weird, like, why is this little green line? This is because over this income range, the family is receiving the maximum benefit, but it's as a mix of the refundable and the non-refundable portion. And I add that so that you can see that refundability goes farther up the income scale than sometimes people realize. If the credit wasn't refundable at all, families in this green region would get a smaller credit. They wouldn't get 2,200. And then next arrow. And then taxpayers receive it all as the non-refundable portion. It's just reducing their income taxes. And then finally, the next arrow is it phasing out for higher income folks. And you can see, unlike the EITC, phases out at a much higher income level. It's not a targeted program. It benefits a much wider share of children across the income distribution. And that's the end of the slideshow, but I hope that kind of orients our conversation about phase-ins and stuff like that.
Yeah, that the visual to me is actually pretty helpful. Um, but so I actually think it's helpful to think about the graphs when I ask this next question, which is what design features with both the CTC and EITC actually help these tax credits both reach the most families and
Mhm.
also reach the families with the greatest need.
So the two that are kind of really important are when the credit starts phasing in. So the EITC is much more targeted towards lower income folks, the bottom 40% of the income distribution, because it starts at the first dollar of earnings and it phases in really quickly, and it phases in faster if you have more children, up to 3 or more children. So where the CTC is kind of stuck, it's like no matter how many kids you have, it's phasing it at a lower rate, 15%. So that means like 15 cents for every 15 cents of credit for every dollar of earnings that you have. And so it just takes longer. It takes more income to get a bigger credit. So outside of removing a phase in entirely, which is again what ARPA did, and we can talk about that. If you want to help low income families, and keeping benefits tied to work, and we can also talk about that, is important. You want to change the phase in. You want to have it phase in at the first dollar of earnings. You want to have it phase in faster, and you want to limit or remove any caps. And that will kind of expand the benefits that low income working families can get while keeping a work requirement if that's important.
Yeah. I think that phase and structure seems really complex. So, I
Yeah.
mean, could you talk a little bit about that and how maybe like a family might experience
Yeah.
that? Because I think that's really important.
Yeah, families don't experience it as a benefit schedule on a chart. What they experience is they get their income, and they usually, most low income families do use a paid preparer, which is an important part of things we're going to talk about. And so they, just like all of us, they kind of get information about their income, the number of kids, and they put it usually into software where someone helps them, and they get a credit amount. And my experience doing volunteer income tax assistance, which I recommend everyone who works in this area do at least once, is people know they're going to get an EITC and they kind of roughly know the size because again, it varies by family size, but they don't know it down to like the exact dollar. So they know that it's going to be big and it's going to really boost their refund. And for some families, that's a fifth to a quarter of their annual income is in that refund driven by those credits. But they experience that the complexity that we see with formulas is really kind of addressed either by software, like you just kind of put that numbers in. What's really confusing for families is determining if their kids are eligible. And that's where we see like a lot of mistakes that are made because you have to go through a lot of decision trees and questions. And even if you've done VITA, you know that there are like tables that you go through, questions that you ask. If yes, go here. The income component looks confusing, and it is in terms of like designing policy. I think what people experience that is confusing is determining if they're eligible, if their kids especially can be claimed for those
Right.
credits. So that's
Gosh.
a great point.
Yeah. Okay. Well, I know we want to dig into some other questions, but maybe I'll save that conversation about the kids and the tables for a little bit later. Um, so I feel like every conversation around the CTC has to mention the American Rescue Plan and how the government expanded the 2021 child tax credit. And the research showed overwhelmingly that this almost halved children's poverty within 1 year.
Mhm.
So what lessons did we learn about what it takes to reach families with the lowest incomes?
So I think that's a great point. The first thing is there were some families that were very hard to reach because they didn't file a tax return. Pam Hurd and Don Moynihan have written about this with their, and specifically about the child tax credit. It worked actually really well. There was a lot of what's called auto enrollment. The IRS would use old data to see like, oh, you claimed a kid, oh, you had this much income. We're going to guess that your credit is going to be roughly this much, and we're going to issue you monthly payments based on that. And we can, like, there were people who did have to repay amounts if they got too much. But again, because the credit, it didn't phase in with income, it was just flat. Changes in your income from year to year were very unlikely to change what you were going to get. It was with kids were moving between households that was going to change it. So we had this program that delivered a lot of assistance very quickly. ARPA was passed in March. Payments went out in July. I mean, the people of the IRS should be commended for what they did with 3 stimulus checks. And
Yeah.
all of that was really done almost in an automated way because Congress had learned from things like the Great Recession in 2008, 2009, that like administrative burden was real and making people like fill out paperwork meant that they were less likely to get the benefits that they were eligible for. So the benefit was huge for the lowest income people. And it wasn't that there was this enormous pool of people that didn't work who had kids. That is not true. Like that is not the experience of most low income families with kids. They work, they don't make enough money to get the full benefit like we saw in that phase in. And so now they could just get the full benefit. 85% or roughly that amount of children in poverty live with a worker, right? So I think it removed the burden, it removed them having to calculate things, it made it easier to auto enroll. But again, really, really low income folks in deep, deep poverty are less likely to file a return. So that auto enrollment process didn't work as well because the IRS didn't have any information on them. And so that was where you saw kind of people going out and trying to inform populations that usually didn't file. Hey, you should file. There are stimulus checks. There is the child tax credit. It's really big. You should file. And there was an expanded EITC for workers without children. And and so it did a lot. It wasn't perfect, but I think there was a lot that could have been built on if that had been a sustained policy. I think for a 1 year stimulus policy, it was administered pretty well. And again, the people of the IRS should really be commended for what they did.
Right. And, I remember that. And I probably should say thank you to other folks that are probably listening to this webinar who also did a lot of that outreach to make sure people filed. But like we just talked about, um, the tables and having to pay for a preparer and all of those things, it does seem to be such a huge like burden for families for something that just happened 1 year. And yeah, it's a shame that we couldn't build on that and, see where we could take it further.
Yeah.
Um, so it sounds like we learned some lessons from the expansion that you came across, and you talked a little bit earlier about f full refundability. So can you expand on that a little bit and tell me what your research has shown for phasing in full refundability?
So full refundability again means that there's no phase in. So instead of kind of looking like a trapezoid, it's just flat at whatever level you want it to be. And these credits decline at the highest income level. So it kind of still phases down at the end. And so you can just, if you're a visual learner, you can imagine like you would get a small amount if you had, let's say you had, well, I can't do calculations off the fly in my head, but let's say you had $3,500, you would get $150 child tax credit under current law, right? Under ARPA, if that child was young, you got a $3,600 credit. That's a huge increase. And so a lot of those increases, again, you see in those families that have very low incomes because either their pay is low or often with low income families, their work schedules are erratic. They don't have as much control over them, or they're engaged in seasonal work or for other reasons. And so you see this like kind of huge increase. And so it really directed the largest gains to those most in need. And again, I want to reiterate, most of those people were working. They just weren't making enough to get the full benefit. And it also eased the ability to administer it. To administer it kind of in that auto enrollment process I was talking about, where you used older data to issue those payment amounts. Income volatility is real for low income families, and being able to just get a flat amount if your income is 20,000 or 30,000, not having to worry about that difference and whether you have to pay it back is really valuable. I think, it started, I think a lot of people thought it would continue. The history of a lot of assistance for low income families in this country is that it has to be tied to work. And there's a lot of scholarship about deservingness and the reasons why that is. Some people want to encourage work. There is evidence that these benefits may have modest effects on encouraging labor supply. A lot of those are from the 90s and are older. But they also exclude people who just have really low incomes and through things that they cannot control. And so
Right.
ARPA kind of changed that.
Right. Well, I think a lot of us here in this room and watching this webinar, we're, policy wonks at a lot of levels. And I think when I hear you say this helps people who have very erratic work schedules, which so much of our po low-income population does have, um, it eased administrative burdens. It reached a lot of people. It helped folks. These are a lot
Right.
of the policy design questions that we face every day when people come to us asking, how do we help more people? So, you know, talk to me about like what went wrong, like can you tell us a little bit about what was the other side of the conversation, just so people sort of have a fuller picture about,
Yeah.
what the whole landscape was that we were dealing with?
So the other side of the conversation was really concern, and this is a perennial concern that will be raised if you decouple benefits from work, that if you don't require or condition things on work, that people will get a benefit and a whole slew of parents will stop working. And there were estimates of what would happen if this policy was made long-term to estimate that. And a lot of people came up with estimates of a few 100,000. And then there was one estimate that was substantially higher that kind of really captivated people because it was about 1.5 million. And that's a lot more. I would say, this is like very in the weeds. These estimates are produced by models where you have to put inputs into those models of how responsive people are going to be to tax credits. A lot of that research comes from older studies that were done in the 1990s around the EITC, a very different time. And most research now shows that people are like modestly responsive to these incentives. There are going to be some people who might get this money and say, that's all I needed. I don't want to either work anymore and drop out of the labor force. It's not probably that many. We don't know. A lot of the research could look at, well, for how long? You can imagine a mom who just had a kid or parents who just had a newborn. Yeah, they might want to be out of the workforce for a few months or maybe the first year of their child's life or cut back on their hours. But after a while, they might go back to work. So those questions weren't asked about how long it would be for, and they also weren't balanced against, even if people do leave the labor force, that could be viewed as a cost. What are the benefits to children and families in terms of all those things you talked about, in terms of having the resources to meet their needs, to be able to buy the things they need for their kids and make those investments? So I think there has been like a beginning of a shift. And when we talk about budgetary costs, it's also useful to talk about the benefits long-term to families and society more broadly. But those
Yeah.
labor supply concerns are always going to be there. I think people who work in this area should just be aware of that literature and think about it hard and how you want to address those issues.
Right. I mean, it seems to be at the very least that we should have more modern studies about, how this tax credit works. But, maybe it's just helpful to say, like, what is the maximum amount somebody could receive from these tax credits? And it's not certainly not enough to have anyone not work for an entire year and do
Yeah.
right. So,
And leave the workforce and lose
right,
all sorts of other things, right? Like they might get health insurance through their employer, or they might then lose access to other sorts of benefits. So we kind of, yeah, we make assumptions that people are gonna, leave because of this, and it's going to be a lot of people. There are a lot of reasons that people are going to stay working, for economic security reasons as well. The maximum, like EITC, is, I should know this. It's something. It's between 7 or 8,000. Maximum child tax credit right now is 2,200. During the pandemic, it was 3,000 if you had a child with 6 to 17, and 3,600 if they were under 6. That amount can be sizable, especially in certain parts of the country. But again, to your point, I don't think it was necessarily like, I think there were some concerns that were overstated about the employment effects. But politically, I think those concerns are always going to be raised, regardless of what the research is. So it's good to know the research. It's also good to know the political reality that, like, we tend to condition our benefits for families in this country on work. And we saw that with OB3, right? Like they were
right,
using, it was different. The tax system in some ways has advantages. You just show your earnings. Work requirements in Medicaid and other programs are different. You have to kind of prove what you're doing. And my colleague Heather Hahn has called those paperwork requirements. Those were put into place to kind of push people off programs. So
right,
we
right.
should be aware of kind of the political reasons that these also come up.
Right, right. And I think this, I know we should probably move on, but I will say like it would be great to to talk about like this and compare it to what childcare costs are in the locality, to talk about work, right? Because we
Yeah,
know that is we'll talk about affordability a little bit later. But
right.
I think let's move on to talk about who gets left out.
Mm.
I mentioned earlier that we already do use the tax system to deliver cash at scale, but how it's designed, many families are left out. So, can you talk a little bit more about who was left behind, the current design of their tax credits like the CTC and EITC, and what lesson should we take away from for that if we wanted to start a guaranteed income program?
Yeah, I think so. With the CTC, TPC produces estimates routinely about kind of the number of kids in families who are left out of the full benefit, the maximum $2,200 benefit. And I think right now those estimates are 19 million children live in families with incomes that are too low to receive the maximum, for their family to receive that maximum benefit. So of that 19 million, 2 million have too little earnings, right? It's like $2,500 or less. So you can see like there are a lot of families, the majority of the families who aren't getting the full amount actually do have earnings. They just don't have enough to get the full amount. And so that is, when you have a phase in, it's just mechanically always going to mean that the people with the lowest incomes are going to get the lowest benefits. And that's why I think full refundability is appealing, because it gets rid of that issue. It gets rid of the phase in. And so those families can get the maximum benefit.
Okay, so now I want to move on to a topic that I know you really like, which is the focus on EITC for childless workers.
Yep.
So we've talked a lot about children. You mentioned 2 million children that are not able to get the benefit. What did your research reveal about who gets left out of our current approach to income support, and what implications does that have for design of cash supports like guaranteed income?
So, working age adults who don't have children are left out of a lot of programs, not just tax programs. And there's been a lot of research. I think 2 years ago, there was a whole Brookings event at it. Bob Greenstein had a paper. I think Zach Perlin had a paper. There were a lot of papers at that event, and I'd encourage everyone to read those papers. I think Bradley Hartley had one as well. And what was really kind of stunning was just how little there is, how little movement there's been on supporting working age adults. Sometimes there's an acronym, and I'm not going to remember it right now. Working age adults who don't have children. And in 2021, we not only expanded the CTC, but there was an expansion of the earned income tax credit, an expansion that had been talked about during the Obama administration between Obama and Paul Ryan. He was chairman of Ways and Means and then the speaker. And so that was as I showed you, it was like a little tiny credit. It was like less than $700. And if you're working full time at the federal minimum wage, which is again much lower than most state minimum wages today, you would barely get any credit. I think like 1 year I calculated it was like you get $20. So it was
Wow.
really not a credit designed to help workers who didn't have children. And that's just a group that is often left out. But I think when we talk about, people not getting married or getting married later, we don't often talk about, well, maybe if they had a stronger foundation and more economic security, they would make some of those decisions or feel more secure in making those decisions. It's like we give assistance once people have kids, but we don't provide any assistance to low-income workers before they have children. And I think we should think hard about doing that. And it was a relatively modest increase budgetarily. The biggest gains were among the youngest workers. Their age limits on that credit too, and those were relaxed. And you saw a lot of young people get this benefit. Again, like it was a modest amount. It was about $1,000. But for people just starting out, that can be, a deposit so that they can move out of their parents' house. That can be money to fix a car so they can get a job. It's still money. It might not be
Right.
as much as you want, but it's still something. And that was also allowed to expire. And so this group that doesn't really get much support, many of them young people, can kind of continue to be left out until they have children.
Yeah, I think that is so timely because I feel recently, I mean, just this morning I was reading about what Gen Z is going through and just the dystopian desert. I believe I heard someone say about the job market and what they are faced with. And these are workers that have, had some form of higher education. And, but, to me, that doesn't matter. We should be certainly thinking about all young people and getting their start because I think there is a generational impact that we are going to see if these
Yeah.
workers aren't able to sort of start off their adult lives and in the ways that we have, most of us have already done so. So,
Right.
um,
It's hard to start adulthood when you are, when there's so many barriers to doing that. And so just thinking about reducing those barriers, I think is important.
exactly. Um, so you're talking about EITC and what's going on now. So I have to sort of ask about the elephant in the room, which is the first, which is budget reconciliation and what
Mm.
we're expecting from Congress now. We've seen the EITC be named in the news as a potential pay for budget reconciliation. It doesn't look like it wasn't in what came out yesterday. I look like in the Senate version. So, can you set the record straight and tell us what are some misconceptions about how this credit works and where improper payments, if any, come from?
So improper payments are, and this is another favorite topic, improper payments are this number of payments that are issued in error, like a dollar amount, and it's usually reflected as a rate. So you'll look at most of those payments are overpayments. There is a small amount that's under payments, but it's kind of that amount divided by the total payment. And that rate has really been pretty constant for a while. It's been between 20 and 25% of EITC dollars are issued improperly. Being issued improperly doesn't mean that it's fraud, because fraud implies intent, right? And in every Treasury report I've ever seen, the annual consolidated financial report, if you guys want to read that, they say the complexity of the rules is really what they believe drives improper payments. And IRS studies of this, literally, have indicated that it's the complexity of the rules, and the rules we were talking about before about who can claim children. Because as you saw with the EITC, you claim one more child, that's a lot more money. So if
Yeah.
you can't claim that child, that's a lot of improper payments. There are also improper payments due to misreporting of income, and you can imagine self-employment income being one of those kind of measures. And that's a common issue, but it's not a high dollar amount issue, because you're sliding up and down either a phase in or a phase out. And so those rules about who can claim them are really at the heart of what drives a lot of the dollar amounts of improper payments. But calling it fraud allows you to kind of shift the blame onto the taxpayer, when I think there needs to be a reevaluation of the rules to make sure both they work for families, so that the benefits are being channeled to the children, but also that people can follow them, that they can comply with them, and that they can verify that they're in compliance with them. If you believe it, like, the improper payment rate used to be much higher. It was over 40% in the late 80s, and Congress saw this as a real political barrier to making it larger, kind of like we do today. And they went and changed the rules around who was eligible and how to claim children. They changed some of those tests, and the improper payment rate over time, and there were some enforcement activities, but those enforcement activities have been constant, and we haven't seen a decline. What really happened in the early 90s was a change in the rules. Those rules haven't been changed for over 20 years.
Yeah.
So I think it's an opportunity to maybe change them.
Yeah. And thank you so much for that. And I know we actually have like a few more questions that we have, but I'm going to stop because we have some questions in the queue and I want to make sure to get to a couple of audience questions. And
Okay.
maybe the first one that I'll just say it's from Mary O'Keefe, who actually notes that the term childless worker is misleading, since there are many
Yeah,
non-custodial parents who do have children and contribute significant amounts to their
that's
support, but
that is
get no
100% true.
recognition. Right. That's exactly what you were talking about. And so, yeah, it's complex. People live complex lives and have a lot of different kinds of families, and it's not easy to have like a sort of flow chart in the tax system, right, to recognize that. So, yeah.
Yeah, that credit, I mean, the long title would be people without children that qualify for the EITC. I think when we're writing about it or making charts or using shorthand, the term childless or without children is used, but it just means they don't have children that qualify for them for the credit. And that includes, to our point, which is spot on, non-custodial parents. They generally don't meet this residency test. They're not living with their child for more than half the year, but they're still involved in their lives. And so that's a really important point. Like, you help workers who are considered childless by the tax code. You can still help children indirectly through their parents, their non-custodial parents.
Okay. We have, yeah, I'm going to try and get through some of the questions pretty quickly. There's like four or five.
Okay.
So the first question is from Lily Liu. What lessons should policymakers draw from cases where individuals with substantial wealth report low taxable income and still qualify for credits like the CTC?
So that's a kind of a bigger question about what we consider taxable income. The CTC phases out not by taxable income, but by a measure called adjusted gross income. You are right. Like, there have been stories of Jeff Bezos paying himself a modest salary and qualifying for the CTC. I think that requires broader reform of, like, the income tax system and how we look at that. And that's not kind of unique to just the child tax credit, right? It's unique to all of those things. But there have been a lot of stories. There's the recent Ezra Klein podcast about kind of the holes in the Swiss cheese of our income tax system. And how we deal with that, because you're right, there are kind of bigger issues outside of these credits about what we consider income and the
Right.
fact that some of the great wealth is not counted.
Yeah. Yeah, and I think it also dovetails with like a question around assets in general and how, a lot of programs, safety net programs then don't let people build assets because of that, right? And that it's
Right.
so contrary to actually getting people to build wealth in that sense, because if you have too much money, then you can no longer get help, which obviously the Bezos example is extreme. So
There is an asset test. It's not on that chart. It's a little over $12,000 and that excludes like your home, but there is an asset test in the EITC. If you have certain assets, certain kind of non-earnings income, you are also ineligible, which is not in the CTC. And so that's where the
yeah,
Bezos example comes from.
right. Okay, we have another question. How would the recent proposal from Senators Booker and Van Hollen to significantly raise tax-exempt income limits impact the effectiveness of non-refundable and refundable tax credits? If proposals like theirs are accepted, would we need to rethink programs like the CTC? That's a great
So
question.
I think that is a great question. So anything that reduces your income tax liability is going to reduce the value of all the benefits, like non-refundable credits, deductions, exemptions that are tied to your income tax liability. So that's 100% correct. You could make the credits refundable. You could put them in the part of the code where all the refundable credits are. The EITC would not be affected because it's still based on earnings. And so that's kind of one approach. Uh, with refundable credits, you just take out whatever your liability is. But that's a really great point about a lot of the non-refundable credits. There's one for childcare expenses, for example, which might just be entirely wiped out because, or significantly reduced in value because people wouldn't have tax liability.
Yeah. Um, I have a question, but I'm going to keep going. Okay,
Okay.
so the third question from the audience is a lot of research shows these credits reduce hardship, but
Mhm.
less focus on whether they're actually enough to meet real costs.
Mhm.
Based on what we know, how should policymakers think about benchmarking benefits against the cost of meeting basic needs?
So, basic needs costs can vary quite substantially from state to state. One of the big drivers of that is housing costs. And so it would be hard at the federal level to kind of create maybe state by state ones. I don't even know if that's legal, but there are state tax credits or state EITCs and state CTCs that can kind of be used to supplement. They're often connected to the federal ones or modeled on the federal ones, or sometimes they diverge in eligibility rules. So I think there's a way to provide additional assistance. To your greater point, like the EATC is increasing with inflation. The $1,700 cap on the refundable portion of the CTC and the $2,200 cap on the overall CTC amount are also indexed for inflation. But that doesn't necessarily mean that low-income families are sharing in the kind of gains from growth. One of my colleagues, Len Berman, who founded the Tax Policy Center, wrote a really interesting paper in 2019 about tying the amount to economic growth, so that as the economy is that
Mm,
basically as the pie got bigger, that you would be providing it to workers. I think it was called the Universal EITC, and it was a different approach. It'd be a
yeah.
little more computationally complex, but it would deliver more benefits to people and share the pie more equally.
Yeah, that's interesting. Okay. Um, I skipped, I kind of went out of order, so just one
Okay.
second. Okay, from Hazel, can you discuss what barriers exist to stop a parent from claiming a child?
So I think the barriers are, it depends on kind of the situation. So first of all, non-parental relatives are eligible. It gets confusing when they live in a multi-generational family because of some of the complicated rules. I think the rules are that you have to have a family relationship, and that includes parents, aunts and uncles, grandparents, even siblings, and you have to live with the child for more than half the year. And With the child tax credit, there's a little exception for certain divorced or separated parents, but it's very similar. And so to the non-custodial parent issue, that can be a barrier in claiming them. You might provide a lot of financial support, spend a lot of time with the child, but not meet that 6-month rule. So that's generally a barrier. And it's also a really big barrier in compliance. It's harder than you think to verify, to provide documentation that you have lived with a child for more than half the year. You have to get at least 2 years of school records. If people move around, that can be complicated. And so that's one issue. I think there's this conception that like only parents can claim it. That's not legally true, but I think parents often live with their families, especially for economic circumstances with other family members. And that's where it can get really confusing because the person caring for the child might be a grandparent, but because of the rules, they might not be able to claim the child. And that doesn't intuitively make sense to a lot of people. Like, I'm raising this kid, why can't I claim this benefit that I'm going to use for the child?
Hmm. Right. And sometimes, life isn't neat like that, right? 6 months or
Yeah.
more, right? And yeah, stability is something that we're trying to seek here for families, and unfortunately, it's not always there. Like you said, moving around and
Yeah. And
and and sharing responsibilities, right?
if a kid
So,
moves around and lives with, like, let's say an aunt for 4 months and a grandparent for 4 months and a parent for 4 months, legally, like, a court, the letter of the law, no one can claim that child because that child doesn't live with any relative for 6 months of the
yeah.
year. So it's just something to think about. It's, yeah.
Yeah. Okay, I'll try to squeeze in one. It's a little outside the scope, but I think maybe from
Okay.
your VITA experience, you might have a perspective here. How do we strengthen enforcement against abusive preparers without discouraging legitimate tax assistance for people who help navigating complex filings like gig workers?
Yeah. So, you know, I don't think there's like one simple solution. I think just starting with regulation and education of paid preparers would be an important start. And there actually is a bipartisan bill in the Senate Finance Committee. I think it is called the TAS Act. Includes part of it is regulation of paid preparers. They are such an important intermediary. The rules are complex, and having someone navigate them is, people often want someone also face to face that can help them, or they use software. There's very little regulation of software. It's kind of emerged as this more common way that people prepare their returns. So I think strengthening that is an important first step. And then you have to see like what happens. Like, legislation is an iterative process, like policy making is iterative. If something isn't working, you need to go and amend it. There's usually no silver bullet, but starting with regulation of preparers, unenrolled preparers or uncredentialed preparers is an important start. And there is bipartisan interest in doing that.
Thank you. Thank you for that. So as we wrap up, I want to just express my deep gratitude to you, Margot, for these powerful insights and for your commitment to explore different policy designs that will support families experience the most financial hardship. Thank you to everyone who joined us today for the second part of the series. The future we build depends on all of us. We hope you'll join us for the next conversation in this series as we continue asking not whether cash works, but how do we design a system that delivers security and opportunity, allowing all families to thrive? We'll share a recording of this conversation on our website, so please be on the lookout for that and share it with any colleagues who couldn't join us today. Our next webinar in the series will be on May 19th, where I'll be in conversation with Bradley Hardy, Distinguished Professor at the McCourt School of Public Policy here at Georgetown. Again, thank you for joining us, Margot. Thanks for all of your great answers and for being a part of our of building a brighter future for all.
Thanks
Thanks,
for having
everyone.
me.